Question for you. Could your business survive without you? If you're honest, most small business owners should answer that with an emphatic, heck no! Okay, if you fell off your perch, as it's said, or got hit by the proverbial Mack truck, be careful out there, guys, especially those Mack trucks. Your family members, your employees, everybody would suffer, or your family members would have to figure out how to quickly operate the business without your guidance. If you're like most entrepreneurs I've met, a once profitable business with trusting customers has now become a sinking ship overnight, all because you decided to not wake up one morning. Now, most small businesses fail to survive beyond the first generation, and one reason is the failure to plan for the disposition of the business if the owner dies or becomes disabled, or just decides to step away from the business and retire. Are you thinking long range with your business? It might be the very best gift you can give your loved ones and your employees. Now, a business known as Hōshi Ryokan, established in 718 AD in Komatsu, Japan, stands as a testament, in my opinion, to the enduring power of family legacy and long-term planning, as it's the oldest still operating family business in the world. It's now in its 46th generation, if you can believe it, of family ownership. Now, the Hōshi Ryokan has navigated through centuries of change, including numerous natural disasters that forced the family to rebuild time and again. And the longevity of Hōshi Ryokan, in my opinion, showcases the importance of strategic foresight in family businesses. I feel like everybody should be running the Hōshi Ryokan, at least in terms of your mentality with your family business. So as I reflect on the story of Hōshi Ryokan, and forgive me if that's mispronounced, I'm definitely no Japanese aficionado, cannot speak the language, but a buy-sell agreement becomes crucial for any business aiming for longevity. Now, a buy-sell agreement is an agreement that outlines what happens to the business interest if a co-owner retires or dies or becomes disabled or wishes just to exit the business. So for Hōshi Ryokan, where a succession plan is almost predestined, a buy-sell agreement would ensure that the transition of ownership remains in the family or to some chosen successor. Imagine there's going to be turmoil anyway whenever the grandfather or grandmother passes away. Even worse when the family income is dependent on that business owner sticking around. So preserving the business's cultural and historical integrity can prevent a lot of disputes among family members or with other business partners, external parties, banks even, just ensuring that the business remains a cohesive entity dedicated to its original vision, even though transitions are going to happen and curveballs that span generations. So the idea of a buy-sell agreement between your business partners and you would have to be an appropriate plan of action to sell the business. At some point, we're all going to exit any business venture you start. In fact, establishing a formal plan of the sale of your business may be the most important action you ever take as a business owner. Think about that for a minute. It seems strange to think about, but we will eventually exit everything in our life. That includes our business. So the question is, did we do it on our terms, or will we be forced to exit by means outside of our control? Now, a buy-sell agreement is one way to ensure the continuation of your valuable business. It'll help guarantee a buyer, and it'll help make sure that your family is taken care of financially. But when we incorporate a bank-on-yourself designed life insurance policy into a buy-sell agreement, there is so much more that can come with this than just simply drafting your perfect exit plan. So a buy-sell agreement is a contract between a company or a company's co-owners to buy, and it obligates you or your estate to sell the business interest in case of a specific event, like the death or disability or withdrawal or retirement from the business. So with a buy-sell agreement, you get the benefits of a guaranteed buyer. Think about that. Who wants to buy a business from someone who's passed away? It's going to put a damper on sales when the owner of the business, probably the best sales gal or sales guy, if you think about it honestly, just passed away, who's going to buy your business from you then, from your poor family? So having a buy-sell agreement guarantees a buyer, and it puts your family and your employees at ease. It also establishes a fair price for your business. It's established before a big triggering event like a death happens, let's say. So you've locked in the price of your business, which is probably the most important part, or maybe even the largest part of your portfolio as a business owner. Next, it keeps the lawyers at bay. You can help avoid a lot of conflicts, legal disputes, which gobble up most people's estates, and the attorneys walk away and laugh all the way to the bank. Well, if you can write that agreement in advance of your passing, this solves a lot of the conflict that comes up later. Next, and again, finally, there's no nasty surprises here. And when you lay out the terms of the buy-sell agreement, it identifies the events that trigger a buyout, and it names all the terms, the purchase price, everything. Now, unfortunately, very few business owners write a buy-sell agreement, and the very few business owners who do write up a buy-sell agreement forget the most important part, which is funding the agreement. Imagine, let's say your business partner died yesterday, and now you're being forced to buy out his surviving spouse's shares in the business. Let's say that business was worth $6 million, and that means you had to come up with $3 million on the spot to buy out the surviving spouse's shares. But you had no money set aside to purchase that business equity. And now you have to take a giant bank loan or sell everything in the business and your personal life just to satisfy the unfunded buy-sell agreement. So the moral of that story is don't forget to fund the buy-sell agreement. So how do you do it? Funding a buy-sell agreement is easy. It can be done a few ways. Here's a very simple way. Obviously, you can be done with a sinking fund, basically a savings account. You can set aside a portion of the business's profit or your personal money. Use it only and specifically to fund your buyout. But of course, doing that means you got to have a ton of discipline. Imagine sitting on $3 million of cash savings and can't touch it, just hoping and praying your business partner croaks. That's no way to run a business, in my opinion. Or you might have to do a bank loan to fund the purchase. This can be risky, and it depends on the business's credit worthiness and the market conditions, which of course leaves a lot up to chance. We don't know when your business partner might pass away. We don't know what bank terms are going to look like or what your business balance sheet is going to look like, even if you can get a loan. However, in my opinion, the most efficient way to fund a buy-sell agreement is through life insurance. By using life insurance to fund a buy-sell agreement, you can do a few things. Number one, it'll complete the financing and guarantee the success of the buyout from day one. That's a big deal. Second, you'll have immediate access to a lump sum equal to the value of the shares of the business that need to be paid out to the surviving spouse instantly, like within a week of the business partner passing away. The money will be in the hands of the surviving spouse, leaving you, the surviving business partner, with all the business shares, all the equity in the business. Next, you'll have extra cash left over for the business in times of difficulty as you make a transition to a world where you have no business partner. That's a big deal, and it'll strengthen your credit position along the way.